5 very difficult years for insurers. Rate hardening is necessary.
Well, there's a lot of discussion about if you want to take advantage of this hard market, what are you going to do to manage the emerging risks?
My definition, bluntly, is if you can't find the capacity you need, that's a true hard market. So we still can find capacity.
The capital depletion is somewhat temporary, and there's that profound difference, as AM Best has noted, between deployed capital and available capital.
As an industry, we've made a lot of statements and a lot of promises, and a lot of it's going to be different next time. And we just really haven't made very much money as an industry over the last several years.
1 year is not yet sustainable, so we need to show longer-term performance to make sure that the capital stays with the industry, insurance, reinsurance and ILS, and if we need more capital, to get more capital.
We think less about sustaining the hard market. We think more about, are we focusing on the risks that are ahead of us?
The reinsurance market has moved from being, I would say, cautious on cyber to cautiously optimistic on cyber.
There is an urgency to reduce the protection gap, not only on risks which are known, like climate change or cyber, but also on new emerging risks.
That it's our capital in this industry that really restores economies and countries and peoples back to normal life. It's not the government.
Reinsurers actually have an opportunity to create value by underwriting. The question is how much to underwrite, when to underwrite, and how to underwrite.
What happens next?
We're in for a very exciting time in our industry.
Well, good morning and welcome to AM Best's 2024 Reinsurance Market Briefing. Great to see so many of you here. I was going to say I hope you all had smooth trips down to Nice and on to Monte Carlo. I know that's not necessarily the case, but you are here, which is great, and we really appreciate you making the effort to turn up for this briefing. Regular attendees will have noticed that we've grown somewhat, so we've managed to double our capacity, which is excellent. Maybe it's in celebration of our 125th anniversary or something, but in reality, I just wanted to thank Gallagher Re, actually, who they own this half of the real estate during the week, and we own that half. So we've done a deal, and it's going to work best for everybody else. I think later in the week this turns into Gallagher House, and we will be located up, as we are normally, for the meetings on Salon Gustave up on -2. Now, the clips you've just seen are obviously clips from last year, the 2023 Rendez-Vous, courtesy of AM Best TV. And what you would have seen in terms of the current market is quite significant. And what a number of executives have said, it's the best trading conditions they've experienced in their career. And indeed, AM Best put the reinsurance sector onto positive outlook for the first time in June of this year. And really the purpose of this briefing is in part to answer that question about what happened next, as posed by Paul Brand on the clip, and indeed what will happen next in our opinion. On the sort of other side of the coin, we are, of course, in the backdrop, we know there is ongoing geopolitical tension. We've got a challenging macroeconomic environment and indeed a warming planet. And all these issues are the ones to be discussed by our panel shortly. Before doing so, just to make you aware of the broader AM Best delegation, up on the screen there. I won't run through them one by one. As I said, we'll be based up at Salon Gustave. Do pop in and see us, whether you have an appointment or not. I will make reference to one individual, top left, Matt Mosher, President and CEO. Matt is in the room somewhere, down the far corner there. Matt announced last week that after nearly 30 years with AM Best and 5 years as CEO, he'll be standing down and leaving AM Best at the end of the year. So this will be Matt's last Monte Carlo, but maybe not his, last Monte Carlo with AM Best, but maybe not his last Monte Carlo. All right, but we wish him well. A few other housekeeping points. The briefing this morning will be recorded, is being recorded as we speak, and it will be available, whoever wants to see it, obviously on our website on Monday together with the material, the slides that are being presented today. We've also produced a number of reports that already may have hit your inbox. I think this year I counted we had 14 reports. I'm amazed there are 14 different sectors we could write about, but it keeps on growing. So you can either access them on the website individually, or there is also a compendium if you want to have the full read. But I think that is on housekeeping. And just then to introduce today's panel. So on your far right, my far left, Greg Carter. Greg is Managing Director, Analytics, and is responsible for all rating activity ex-Americas, so covering our offices in Singapore, Hong Kong, London, and Amsterdam, and Greg himself is currently based in Singapore. Next to Greg, Angela Yeo. Angela heads up the analytical team for our office in Amsterdam, which provides our EU 27 coverage, obviously including 3 of the big 4, Swiss Re handled out of London. Next to Mahesh. Mahesh heads up the analytical team in London, responsible for the balance of EMEA and including, as I mentioned, the Swiss Re rating and the Lloyd's rating, which in fact itself was upgraded in July of this year. Moving down the line, Carlos Monfupé. Carlos based in New Jersey, and Carlos heads up the global reinsurance team, as we call it. I describe it as our centre of excellence, and in his day job, he covers the US and Bermudan market. And finally, Stefan Holzberger. Stefan, also based in New Jersey, is Chief Rating Officer and responsible for all our rating activities worldwide. So with that, I will pass to you, Stefan.
Thank you, Nick. Good morning, everyone. So we have a full agenda for you today. We're going to kick off with Carlos going over our market segment outlook for the reinsurance market. As you just heard from Nick, we have a positive outlook for the first time ever on the segment, and Carlos is going to talk about the unique characteristics of this hard market. From there, Mahesh is going to walk us through the operating results, and we'll talk specifically about how the different subsegments of the reinsurance market have performed and what that outlook from a performance standpoint looks like for this year and going forward. And we'll talk about the specific challenges around peer analysis with now the IFRS 17 adoption for many of the companies we follow. After Mahesh, Angela will talk about available capital. We'll talk about the level of traditional and alternative capital in the market and how that's grown. And we'll delve into why we're not seeing the new company formations that we've seen during prior hard market cycles. From there, Greg will talk about what are the challenges for the reinsurance segment, what lies ahead in terms of potential challenges that could disrupt the favorable operating performance we're seeing today. And then finally, we'll hand it back to Carlos to take a look at the next year or two and really kind of what's in store for the market from there. So with that, I will hand over to Carlos.
Thank you very much, Stefan. Yes, I will start by explaining why we think that this cycle is a bit different from previous ones and why we took our time before making this important decision of changing our outlook to positive from stable after a number of years. And so here we have a comparison of what has happened in recent hard cycles. And I would say the main way to characterize previous cycles is a significant large event which would erode capital, it would put pressure on the solvency of a number of companies, and that would trigger a sharp increase in rates within a relatively short period of time. So that we saw in 1992, 2001, 2006. Now, something that has changed that dynamic in the last few years has been interest rates. Say 2011 was a year when we had significant cat activity, but very low interest rates. We had the market awash with capital. The movements in rates online was very localized in particular regions affected by these events. Now, the last heavy cat year that we've had is 2017, Harvey, Irma, Maria. And since then, we saw a slight recovery in prices. So that was a gradual process, and a gradual process as well when companies started shifting slightly away from property cat. But that has been a price discovery phase, very gradual. And every year the whole market was asking, say, when that point would stabilize, until it wasn't until the renewals in 2023 when we had that step change, and it was very clear, it was a very decisive point when we could see that hardening in the market. But one of the things that we have to realize is that it's been only last year when we saw prices actually getting back to the levels last seen in 2006. So it's taken 17 years to get to that point. Now, what we see as well is the impact of the increasing interest rates. So we had that long period of low interest rates that started in 2008. That started to get corrected 2017, 18. Obviously, during the COVID pandemic, all the stimulus measures negated those previous movements in rates, and again, we had, say, a more prolonged period of correction. But say, at the moment, what we see is that after the excellent results that we saw last year, so that process actually has created conditions where this situation is more likely to stabilize at a higher point and remain the case for at least a couple of years.
Just add to that, I think. If you look historically at what's happened with the insurance industry or reinsurance industry, there's often been a correlation between the impact of interest rates, and higher interest rates historically encourage cash flow underwriting, which actually led to softer market cycles. But this cycle is different, as Carlos has highlighted. I think it's important to flag that the expectations of investors, because of the poor returns for so many years, is another one of those factors that's driving the hard market.
So based on this, in early this year, we moved the outlook to positive. One of the main points that we've made is that it's not just about pricing, but mainly about de-risking. So the changes in terms and conditions, the increasing attachment points, the tightening of wordings is as important, if not more important, than prices themselves. And that's why we believe that these underwriting margins are sustainable in the short to medium term. The role of reinsurers has come back to their historical position as protection of balance sheets rather than earning stabilizers. So I think that during the time of cheap capital, of low interest rates, actually, say the allocation of capital was excessive. It allowed reinsurers to actually offer capacity where they got involved in high frequency layers that now they are retrenching from. So that position as capital protection in a capital protection role has actually been restored. More important, as we will see later in the section to be covered by Angela, we don't see the capital depletion that we had seen in previous years. Yes, there has been a bit of volatility in capacity, but we've made a significant difference between available capacity and dedicated capacity. What we see is, the largest companies have been able to retain profits at significant levels. The market remains very well capitalized. The way that capital is being utilized has become more efficient. Obviously, companies are being more careful, more cautious on how they deploy that capital. But at the same time, we don't see the need, we don't see pressure for new capital entering the market. We don't see that, we don't think that that's impossible, but it's unlikely to see disruptors in the market as we had seen in previous cycles. The other point to mention is that it is clear that cat activity in recent years has been more focused on medium-sized to small-sized perils, for which the reinsurance segment has been largely, isolated because of the changes in terms and conditions. So there is still this tension between the primary sector and the reinsurance one. And I think that, at the moment, that is a situation which is here to stay. There is some room for realignment, but we don't see that changing dramatically in the near term. And more than that, what I think that is very clear is that investor appetite is putting lots of pressure on management teams to maintain that discipline, and that is, to a large extent, what explains the lack of emergence of new entrants as well.
Maybe to add on that, one of the questions that we get asked is about, if we factored in the current issues around the casualty business. And I would say, yes, of course, we are looking very closely at the developments there. The concerns around the adverse reserve developments in the casualty books, specifically in the US casualty books, is a concern. But as I just said, it is really concentrated for the moment within the US casualty books. So we have seen some rate softening, but that is sort of limited to some pockets of the business. And the main question is really how industry-wide the issue might get. So for the time being, we don't see that, and that it is an impact, that is having an impact on the global casualty lines. But there is the potential, so we will have to keep a closer look on that. And generally, to add on as well, our outlooks are a 12-month outlook. So as I said, we will watch this space very, very closely, and we might very well down the line in one of our other, when we revise the global reinsurance market segment outlook, it might then play a role. But for this one, it didn't have an impact on our outlook to keep that at positive.
So looking forward and summarizing the main drivers behind our outlook, we said de-risking has been as important as increasing pricing. Even if prices stabilize, the key point here is whether those terms and conditions relax at any time, and we don't see any signs of that happening. The segment remains very well capitalized, and actually it's the largest companies which have been able to retain those profits and save those resources to deploy in times when, prospects seem very promising. We don't see disruptors coming into the market yet, and that's probably going to take a bit longer. One of the challenges that clearly we have mentioned for the last couple of years is that there is an increase in demand for more complex risks, and definitely there is a role in the broader economy that the segment needs to play, and we see this as being very well positioned to take advantage of those opportunities. And the other point is something that may dramatically change the situation is if we were to see a significant change in trends regarding the economy and interest rates. At the moment, we see some decline in interest rates, some control on inflationary pressures, but still at a higher levels than what we had seen just 2 or 3 years ago. So, and companies, despite the fact that they are benefiting from those higher investment returns, we don't think that they are factoring that as something within their underwriting strategies. On the contrary, so the focus is on underwriting quality and taking any investment return simply as a benefit, which is not a key part of their business plan.
Right, and going back for a moment to the demand for complex risks, I think that speaks to the relevance of the reinsurance segment that's getting a lot of protection, as Carlos has just mentioned, in terms of the segment scaling back its coverage for the more volatile classes of business. From what we hear from our clients and what we see in the market is there's very much an appetite from the reinsurance segment to work with the primary market to cover complex risks, whether that's cyber, intellectual property, coverages for emerging innovative technologies. The expertise and the risk appetite is there, but as you've heard already a couple of times, the appetite for those volatile classes, reinsuring secondary perils, and providing that income statement protection is not there in the market today, and we expect that to remain the case.
So finally, how does this translate into the results that we have seen? As I had mentioned earlier, we think that after 2017, prices started to increase gradually. The risking measures as well started to be put in place. We saw the first signs of those underwriting results turning from losses into profits in the last couple of years. Actually, 2022 was a positive year from an underwriting point of view, with a 96% combined ratio for the segment on average, but that was heavily negated by the unrealized investment losses that we saw on fixed investment portfolios on a number of companies because of the sharp increase in interest rates. 2023, and deliberately here we have included separate figures for the US and Bermuda and for the European writers, mainly reporting on IFRS 17 because of the lack of comparability that Mahesh will cover later. But we have seen a sharp increase in ROEs and in combined ratios as well. So obviously these results have benefited from investment results, but mainly because of that underwriting discipline. So even with the challenge that the adoption of IFRS 17 and the challenging comparability that we are finding, I think that all the indicators are moving in the right direction and are showing a very positive position in which the segment is being found at the moment.
I'll just add that. So we've seen significant step change in 2023. So one would say, well, why hasn't that happened earlier? So following Harvey, Irma and Maria, as Carlos mentioned, some of the rates have been steadily improving, but then we've had to contend with the COVID effect in 2020, which have depressed some of the claims activity, followed by the improvements coming through, as Carlos mentioned, in 2022, but the unrealised losses coming through. So we are seeing a market step change now, both on the underwriting side, not just to the rates, but the other actions that have been taken on terms and conditions, moving further up the structure on the reinsurance market, and then the reinvestment rates improving as well. So now it's a question of how long is this going to last going forward.
So moving on to the next section, it's regarding operating performance and IFRS 17. And there's two main messages I'd like to get across here. Firstly, as we're seeing, the results have been exceptionally good for 2023, and that's continued into 2024 as well. If you look at the half-year numbers, some companies have posted record profits during the course of last year and this year. But overshadowing all of these numbers is our very favourite subject of IFRS 17. And there is some interpretation required for IFRS 17. Now, one of the big questions out there is always, is the market or are companies meeting their cost of capital? And, the picture here, if you look at the history, doesn't paint a good view of the market. And the market has generally struggled to meet its cost of capital. But in 2023, we see a marked change in the ability of the companies to generate sufficient profits to cover their cost of capital. And I would say, based on what we have seen so far during 2024, obviously there's still a number of months to go, that trend is expected to continue. So at the bottom here, we have the blue line, which is the traditional approach where we look at the
median weighted average cost of capital, which is looking at, say, the change in debt, the change in equity, but it's based on, say, historical numbers, historical trends. So some of the debt issued in a low interest rate environment will play into there. And clearly, companies are meeting their cost of capital during 2023. But we also looked at another measure, which is the median market derived capital pricing model, which is more of a forward-looking approach, looking at, say, put option prices and the investor sentiment in terms of what they're after in the market. So the top one more forward-looking and the bottom one more backward-looking. And you'll see that the expectations that investors have is quite higher compared to when you were to look at the historical trends here. Now, one caveat with that is that the sample size is a little bit lower, and if you were to remove a couple of the data points, then maybe that line would draw back. But under both measures, the ability to meet the cost of capital has been good. This year has been at that, which has been indicated by the market.
Probably just a comment there, and I think that, say that yellow line probably from our point of view reflects a bit better the expectations from investors for a minimum return on new investments within the sector. And the other thing is that we need to highlight the fact that meeting that cost of capital, even on historical terms, has happened only twice in the last 7 years. So it's a bit playing catch up. Yeah. So it will take a while for everybody to feel comfortable about it.
So this is a little bit of a busy slide, but it's depicting how the various segments have performed. And clearly, as illustrated in 2023, across all of those cohorts, all of the segments, there has been an improvement in performance, not just on the combined ratios, on the ROEs as well. But maybe to just pick out a few points from the charts. So if you look at the trends in the ROEs, you'll see that the US, Bermuda and the Lloyd's market has been more volatile than, say, the larger companies or the big four in Europe. And that's partially indicative of the different profiles that the US, Bermuda and Lloyd's market have, which is very PC, US heavy over some of the Europeans that have a lot more diversification into business that is outside of the US, in addition to a significant portion of life reinsurance that they write as well. So that sort of shapes or gives you an understanding of how the different portfolios react, and the fact that when you look at the big four, you don't expect them to have those peaks on the highs and the lows. They sort of operate within a narrower band due to the diversification that they have. So we've mentioned about the great performance of the market with the layering and moving up the ladder, and some of those lower level cat risks moving down into the primary market. With the reinvestment rates that companies are now achieving, and you see that the ROEs are very good for the US and Bermuda segment. I think that's also been emphasised in Bermuda to a certain degree to the tax reforms that are happening there, and the amount companies have taken for the deferred tax assets on their balance sheets at the end of 2023. So that's boosted some of those numbers to a certain degree. But even without that, the numbers would still be looking good. Moving down to Lloyd's, exceptional results for Lloyd's, and they continue to improve. At first half of 2024, they've announced record profits for this year as well. So clearly, the structural changes, the operational changes that they've made are turning into fruition, and that's translated into better combined ratios. They have some of the best loss ratios as a market overhaul were within Lloyd's. And there's always been discussions about the expense ratio in the past that Lloyd's been on the high side. So while that has also improved over the last few years, it is still operating above what we see of the other segments here in the market. In Europe, again, we've seen a material improvement going into 2023 for the players there. Now, we have to understand that the combined ratio that's stated here is under IFRS 17, so it is a discounted combined ratio. If you were to unwind that discount, then you're probably looking at another possibly up to 8 percentage points sort of difference. So still operating very well, but you just need to take that into consideration. On the AP side, they've generally been hovering at the 100% combined ratio for the past 4 years, and again, like everyone else, they've benefited from the changing market conditions, the higher rates, etc., to post, say, much better results. Reminder that it is under an IFRS 17 basis as well, so it's a discounted combined ratio. The combined ratios are now, the definition of the combined ratios now are very different.
Mahesh, maybe a couple of points on the life re side. The biometric reinsurance business is performing extremely well. That is concentrated across 4 or 5 large global players that have a very strong command of that market, and that has traditionally been a source of profitability. On the annuity side, I think it's worth noting that the U.S. market, obviously a very large market for annuity business, has just been exploding over the last, say, 3 years. And a lot of that business is finding its way into the reinsurance market. We've seen a number of new reinsurance companies formed in kind of offshore domiciles, whether that be Bermuda or the Cayman Islands, and a lot of newcos on the primary side with PE backing, or even in more cases, asset managers who are receiving fees and commissions for originating assets and then moving those assets into their reinsurance subsidiaries, and then a good bit of that risk moves offshore to the reinsurance segment. So that's kind of I think an interesting dynamic that we're seeing on the life re side. For the most part, these assets are good quality, but we're also seeing a very material increase in private assets moving their way into life insurance and reinsurance companies. So a little bit harder on the valuation side, and liquidity testing becomes more important under those circumstances.
And maybe also looking at the European life reinsurers. In 2023, they have all had improved performance results, largely benefiting from reduction in the pandemic-related deaths, although we still do see some excess mortality for the US books. In looking into 2024, again, we sort of expect that trend to continue, apart from SCOR, who has recently issued a profit warning. I'm sure you've all read about that. And there's an ongoing reserve review, which will likely negatively impact their insurance service results and the life pre-tax CSM. But yeah, other than that, I think life is looking strong into the future as well.
Yeah, the only other point I'd make in relation to 2013 and going into 2014, and I mentioned about the casualty reserving as well. So some companies have taken the opportunity with the results that they're producing to be a bit more prudent on the US casualty reserves as well. Finally, for this section, something that was very simple needs a little bit more interpretation going forward. So we have the top 50 reinsurance group that we've always sort of issued over many years now. So there's been, say, a transitional change this year, with many IFRS reporters adopting IFRS 17, and some other ones, obviously we haven't got the full list here, will be adopting IFRS 17 over the course of the next few years. So Swiss Re are adopting it this year, so end of this year. Their reinsurance premiums will now move across to reinsurance revenues. What we've wanted to do here is to keep the data as accurate as possible, based on information that we've received from the companies or public data that is available. Because IFRS 17 is completed under a very different basis, you do not have a direct comparison between written premiums and reinsurance revenues. So it is very much subject to the type of business that the company is writing, those reinsurance contracts, whether it's excess of loss, proportional, etc., in terms of how one would get from A to B. So without a company having the detail and running that exercise, I think it would be a bit crude to run estimations of that. One could say if you were to move from reinsurance revenues to reinsurance premiums on the non-life side, it could be up to 35% difference. For life reinsurance, that could be considerably more. In addition to that, we've seen some movements in shareholders' equity overall that they've moved up, but where we're seeing the bigger movements is where you've got the life reinsurance component and how much companies have decided on the day one transition to move into, say, shareholders' equity, and how much of that moves into the contractual service margin of the company. And the last point I'd like to make here is clearly the combined ratios are not directly comparable. As mentioned before, the IFRS 17 combined ratios are generally discounted combined ratios. So while a lot of the terms under IFRS 17 are the same, some of the definitions are a little different. So with that, I'll hand over to Angela.
Thank you. Yes, and I will cover the available capital. So let's first have a look at the estimated dedicated reinsurance capital. So AM Best, together with Guy Carpenter, for the past 12 years have created this analysis, whereby Guy Carpenter is estimating the portion of the third-party capital, which is shown here in yellow, and AM Best is estimating the traditional capital, which is the blue part of this graph. Maybe if we first just look at the total sum of the bars, and we can see a trend over all these years, an increasing trend in dedicated reinsurance capital over the years. AM Best estimates for 2024 to the dedicated reinsurance capital to reach an all-time high. 2023, if we are looking at the traditional capital, it has recovered from the 2022 impacts, which in 2022, we've mentioned it a few times before already, was impacted by the unrealized fixed income. So the losses were either recouped or they were realized and then reinvested again. Also on the alternative capital, investors' appetite was increased, and a lot of that capital went into the cat bond segment, partially due to their sort of short duration exposures. So in fact, since the market shifted in 2022, AM Best has not seen any new capital entering the market via startup reinsurers. Instead, reinsurers have raised capital throughout the year to support their growth initiatives. We've seen increased retained earnings, and as we said, investors have allocated money towards the cat bond markets. Carlos has already mentioned the rate on lines. We've plotted them here again to just show the trend, and again to sort of emphasize how the turning point of the low rates started in 2017, where the hard market slowly started, and then as we see in here very clearly again, a step up in 2023.
Yeah, probably just a couple of comments there. One is, let's note on the ILS side that after 2017, actually, that was an area which really plateaued after, say, several years of sharp growth before 2017, and it was actually hovering around 95 billion. It was only in the last 2 years that we have seen renewed interest, initially on the cat bond area, and now we see some on the collateralized reinsurance space as well. And on traditional capital, this means the rated balance sheets, what we see is actually it's not because of new entrants, it's because of the recovery on unrealized investment losses that we had seen in 2022, and the retention of profits internally generated by the largest companies.
Mm. Yeah, you also see in 2022, we've put down an estimation of the impact of unrealized losses, where AM Best has always assumed that companies that have, ample cash liquidity will just be able to recoup those.
Most of that has been reversed.
It has been now, exactly, yeah. So, it's one thing to know about how much capital there is dedicated to the reinsurance market, and then there's another question about, an interesting point to make is about the actual capital utilization. So let me just briefly explain what we're doing here on this slide. So we use our capital model, and we are estimating how well the market is capitalized on a risk-adjusted basis. So we're looking at the required and at the available capital. And we are asking ourselves two questions. So the first one is, how much of the available capital is required to maintain risk-adjusted capitalization at the strongest per car level, which is for us the 25% at value at risk, 99.6% value at risk. And then and that's shown here in the red line, with the red line. The blue bar represents the other question that we're asking ourselves: how much capital would it take to be depleted to drop to our per car score with a 10% value at risk at 99.6? So this level has been chosen as it can be interpreted as a sort of a risk tolerance for extreme scenarios, or in other words, when reinsurers' capital drops to a 10% per car, we would be looking at the ratings and would look a bit closer. So basically, in other words, the blue bars you could also describe as excess capital or capital buffers. So with that, overall, we can see that we believe that there's sufficient healthy margins given the good profitability that we heard about before, and also the dividend payouts that we've seen. In 2022, we see a sharp increase in the capital utilization, and this is because of the increase in the required capital, but also compounded with the decrease in available capital. We can see that the capital buffers in that year have decreased by more than half compared to the prior year. So as we said before, we have expected that these unrealized losses will be recouped in the near term, and we've seen that in 2023. It's already happened. And whilst the capital buffers are still a little bit lower compared to 2021 and before, they are at a good level, and the capital utilization is also fallen below 100%, which means that capital is not reached the below 10% threshold that we've applied.
Right, so just one more point on the 2022 figure. So you can see that capital utilization went above 100%, which means that for the market, BCAR scores dropped in some cases below the 25% threshold. And you've heard us talk a little bit, or a fair amount so far, about the unrealized losses on fixed income and how we saw that as temporary. We didn't see any negative rating pressure despite those risk-adjusted capital metrics in 2022, because again, we saw that as a temporary measure, and we saw that the market had ample liquidity to ensure that they wouldn't have to liquidate bonds that were underwater at the time.
Thank you. So now we're looking at the capital allocation from reinsurers. So for many years now, AM Best has noted a gradual shift in reinsurers moving their business mix towards also primary insurance and specialty insurance lines. In fact, 2023 is now the second year in a row where the capital allocation towards the reinsurance segment is below 50%. Now, maybe at that stage, I just want to add that this, the perspective or the scale of this graph is a little bit zoomed in, so the differences might appear much larger than what they actually are. But we obviously want to bring home our point that that a shift has happened, and we can see that certainly from now you have to look at the colors from 2019 onwards. The primary insurance segment has grown quite substantially. Now, one part why the reinsurance capital allocation for the last 2 years has been lower is, again, at the risk of repeating myself here, is to do with the change in how reinsurers allocate their capital towards Nat Cat, how they've changed their underwriting strategies. So meaning the exposure to, for example, Nat Cat has been reduced. And I don't know, Carlos, if you want to say, because we see a similar picture in 2015 and 16, but that's very different, right?
Yes, if we look at the split between 15, 16 and 22, 23, they look similar, but actually the drivers are different. I think that 15 and 16, the lower weight on reinsurance reflects actually a very soft market And that percentage starts to increase as the market starts that repricing process. So that's what it explains that increase. And later, the decline is actually because of a reduction in exposures despite the high prices.
Mm-hmm. Yeah, so I think, in general, what we can say is that reinsurers have had track record to be agile and to be innovative when market conditions are changing, and that is very well reflected in that slide. My last slide, just very briefly, I want to look at the PML, the probable maximum losses, as a percentage of capital. And again, generally speaking, over the years, PMLs in relation to capital has been relatively stable. We do see two outliers here. So we see a drop from 17 to 18. Again, that is caused by the Harvey, Irma, and Maria events. And then we see another drop in 2023, which has the same underlying cause as mentioned earlier. Again, reinsurers moving away from property cat and changing their underwriting strategy around that. But in general, I think the message here is reinsurers are managing their PMLs in line with the capital available. Okay? And I'll pass on to you.
Thank you, Angela. Right, this is the section for all the pessimists in the room, all those that have been disappointed by the positive outlook. So I'm going to spend a few minutes just talking about what we see as the key challenges for the sector, and break that down into short-term challenges and longer-term issues. So I'm just going to pick out a couple of these things here. Obviously, Monte Carlo, there's always discussions about where we are in the cat season, and this year the forecast at the start of the hurricane season was that it was going to be more active, more storms, more landfalls, more losses. And Beryl didn't disappoint. We got off to a great start from that perspective. But it's been rather quiet since then. And I think you can draw absolutely no conclusion from that whatsoever. And I think I'm not going to make any forecast for the rest of the season, other than Man City winning probably. But so the issue is, seasons come and go. There's a tremendous variability despite the forecasts. The forecasts get great headlines at the start of the season, particularly when reinsurers are trying to reprice the business. But the important thing is to look at the longer term trend, and I think it's undeniable that we will see the increased ongoing trend of greater severity and frequency of storms and greater losses impacting the insurance industry ultimately, or greater economic damage being caused, and that presumably being picked up by the insurance sector. So I think that it's a challenge. How much of a challenge it proves to be this year is difficult to predict, but it will continue to be a major challenge for the sector. Economic and geopolitical issues, I think, have been very much in the focus. We've already talked about it a little bit today in terms of interest rates starting to decline. And we've seen that in Europe and in the UK. Interest rates have come down. In the US, we're expecting interest rates to come down this month as well. And if anyone's watching the stock market in the last few days, then I think Friday was a bad day on Wall Street. And that reflects investor concerns about economic activity globally, and are we seeing a slowdown in global economic activity? And I think what that could signal is a move more towards looser monetary policy, lower interest rates again, to stimulate the economy. And that's fine if it works, but I think if you look back at the history for the reinsurance sector of what ultra low interest rates have meant, it's meant excess capital, it's meant declining rates, increased competition, and many of the problems that we've talked about through the long soft cycle have been exacerbated by low interest rates. So that's potentially not a good thing for the industry. Geopolitical issues, a lot has been said and written about that. What's clear is that the tensions around the world are not easing, and that becomes a significant challenge for the sector, and will continue to be an issue through the end of this year and into next year. Obviously, the big one to watch is the US election, and I'm going to avoid straying into politics. But if you take a sort of longer term view of what the insurance industry does, and if you look through different political cycles, then the industry seems to rumble on, and there may be short-term disruptions by significant changes in political opinions and political powers, but the industry tends to find a way to cope with that. I think it is potentially the prospect of a Trump presidency that could potentially bring increased protectionism, higher tariffs on goods, and that potentially slows down economic trade. And that clearly is something that's probably not good for the industry longer term. And then finally, US casualty reserving. Again, we've touched upon that as well, and social inflation. But perhaps I'll ask our resident American on the panel to say a few words about that.
Thanks, Greg. So if you're involved in the U.S. market on the casualty side, I'm sure issues around social inflation are front of mind. Litigation finance and the nuclear verdicts, if anything, have grown. It's something that's been getting a lot of attention for a number of years, but a little bit like loss reserves on commercial auto, it just seems to go from worse to even worse. And I think that's an area that's very difficult for the insurance sector to combat. Litigation finance is now a extremely profitable profit center for private equity, hedge funds, and other investors. So we see more and more outside capital being allocated to that, and in the environment we're in, we do expect that to be an ongoing challenge for the market.
So then just a few words. I won't talk through all of these, what we see as longer term challenges. I think there has been a lot of focus recently on the accuracy of property cat models. I'm always reminded of the George Box quote, all models are wrong, but some are useful. I think it's probably fair to say that the property cat models are useful. I won't comment as to whether they're value for money, that's for the users to decide. But in terms of are they useful, they've certainly helped, but I think it does prove that companies can't become overly dependent upon a model or a small number of models, and there needs to be a balance into how they manage their risk appetite. That sort of leads into cyber risks as well, because I think the modelling of cyber risk is at a much more nascent stage, but we are seeing some developments there. Cyber it's been a big growth story in recent years. I think the CrowdStrike event of this year was, it didn't prove to be the cyber cat that people thought it could be, but I think it's a very important wake-up call for the industry. Bear in mind that was not a malicious act. You would assume that a malicious act could achieve a lot more if it's set out. But it did highlight the interdependencies on cloud computing and storage, and what the potential impact could be. Obviously, the rapidly changing nature of cyber risk makes it an even greater challenge to model. So I think we'd add that extra note of caution in terms of dependency on cyber models. But actually, one thing I would want to say is this industry is great at being negative about itself, or the press can often be negative about the primary insurance market. But I think cyber is a success story for the insurance industry. You go back a generation, this risk didn't exist, and the insurance industry has come up with solutions to help with risk transfer and risk management. And I think the industry needs congratulating for that. I don't think we celebrate enough of the positive aspects. So with that, I don't know if any of my colleagues want to comment on any of the other points or any other risks.
I could make a couple of comments. AI, I'm sure will get a lot of attention at the conference this year, and a lot of our clients are experimenting with AI. It may not be in full production, but I think as they should be, they're playing around with it, trying to understand how it can positively affect their business. One of the things that when you talk to AI experts, I hear, and it really resonates, is you don't need a giant AI platform to have a powerful tool to aid in underwriting, pricing, and risk selection. ChatGPT, it can take tens of millions of dollars to update that algorithm and update that platform, and use up as much energy as a small city. But from what we're hearing from the experts is that's really not necessary, again, to have a powerful tool on that front. So the other aspect being in a heavily regulated industry, the importance is to keep the algorithm as simple as possible, understandable, explainable, and to have a very strong regulatory and governance framework around it that can be explained to the regulator so they understand it's not just a black box, and you can try to keep that simplicity there where you're guarding against unintentional bias, for example. And then, of course, I won't spend, for the sake of time, too much time talking about PFAS. Obviously, the potential for casualty catastrophes is a big one. Is PFAS the next asbestos? We don't know, but the class action suits do continue to grow. We've seen some very large settlements within the chemical industry, so certainly one to watch.
Okay, and then my last slide, I'll be very brief on this. This is a slide we put up most years in terms of looking at the price to book values for quoted insurers or reinsurers. Just a comment to say that we are reaching a bit of a peak in terms of these valuations, which I think is a reflection of investors' positivity about the industry. And the question we often raise is does this mean that we can expect to see more M&A activity? I think when people see this chart at one extreme or the other, there's an assumption that M&A activity will pick up. I struggle to find any correlation of that. I think there's a lot of other things that affect M&A, where we are in the interest rate cycle, relative cost of capital for insurers versus other industries, and the organic growth opportunities. And if companies are struggling for organic growth, then M&A is a route. So again, one to watch, but not a strong indicator of increased M&A.
Great, thank you. And with that, we move to the final section, just to summarize and give our expectations for the next 12 months. First of all, what we were saying last year, and we have to say, yeah, we got everything right. So basically, so a bit more of what we've been saying. So the underwriting profits continued during the year. That discipline, we saw that. Inflationary pressures, high interest rates, social inflation, those are topics that we have been discussing. Slow expansion, emerging risks, rate increases at a slower pace. We don't see those new entrants disrupting the market happening yet, and renewed appetite for volatile business. So we've seen that with the uptake on the ILS market capacity as well, and the higher retentions here to stay. So this is what we said last year, and I think that to a large extent that has been applied. For this year, I would just probably moderate some of those very strong assertions that we made last year. So we still expect continued underwriting profits to remain solid, slightly lower probably, but still strong. Again, with rate movements, we have seen some declines on strong performing risks, but nothing dramatic. So the key point here, I guess, is investor pressure, investor appetite, and that renewed, pressure for market discipline. So with retention levels, again, we don't see significant movements into working layers. Inflationary pressures, interest rates, Greg had mentioned, there are some expectations of declines, but nothing similar to what we had seen during the long period of low interest rates, with rates below zero or even negative. So we don't see that happening. Again, so there are some announcements about new entrants in the market, but I think that will continue to be something slow and unlikely to disrupt the market. And the increased use of alternative capital to flex those capital needs, that's something that we see increasing. We saw the uptick on the ILS capacity. More and more ILS and traditional capital are working as partners, so the participation of traditional capital in new risks is at sometimes even conditioned to the appetite that we may have from the ILS markets, and they are not the rivals, the competitors that we saw in the previous years. And with that, I would say probably the key takeaways of our presentation is that we expect those strong results to continue to be maintained. It's still a payback to investors, still catching up. We don't see capacity shortage. We consider the market very well capitalized and disciplined, and the positive outlook simply reflects our expectations of that profitability to continue to be sustained for at least a couple of years.
Well, thank you, panel, and thank you for that round of applause, indeed. I particularly like the self-deprecating slide about we're quite good at predicting the future. Maybe you guys should be on the street, I'm not sure. If any of you are thinking of possibly moving on to another rating agency presentation, you're only going to get wet, so you might as well stay here.
It's coffee.
But without embarrassing anybody who's leaving the room, but we do have time for some Q&A. There should be some roaming mics if you could just wait for the mic to come so we can pick it up on the recording. So, anybody have a question at all? All very quiet. Yep, we've got one over there, Charlotte.
He's coming.
There's a microphone coming.
Sorry. Coming.
Sorry, it's just coming, literally. Thank you.
Thank you. Would you be able to comment a little bit on your component on the secular risk on the climate change? How are you thinking about changing your models to include this higher frequency and more severity in the statistical models?
Okay, who would like to?
Maybe I'll start with that one. So if I understand correctly, the question is, how do our capital models reflect climate change and the increasing frequency and severity of catastrophe events? So I think the short answer is we don't expect a significant change in the model. What we foresee is the implications of climate change, while meaningful, moving up that severity and frequency in a gradual path, right? And the long-term implications are known. We do expect that the conditions will promote more severe events and more regular events. You also have the aspect of increasing asset concentrations in these highly prone catastrophe events, which is also a major kind of impetus for the increasing severity of the events. But, our capital model and the risk factors for property cat exposed lines of business looks at the performance of those lines year over year. And although we would expect increased capital factors to reflect that, I don't think we foresee a step change in required capital in the next year or two.
And apart from severity, there is also consideration of correlation between the events, and obviously the correlation between the events geographically and the type of events also increasing. Do you think about this increased correlation? Because really, if you think about reinsurers, which is a sort of higher level of protection, then it's primarily exposed to the increased correlation rather than anything else.
That one I might need to think about for a little while, the increased correlation. I mean, really what we're seeing in terms of the reinsurance segment's reaction to what's happening in the market is, and it's being driven, as Carlos and others have mentioned, the investors are not happy with that kind of negative volatility. They're not happy with several years of the reinsurance segment failing to meet its cost of capital. So, when you talk about correlations, I think really what the market is looking at are the bottom line results. And the reinsurers are using advanced technology to look at the correlations and look at the concentrations and try to manage away from the kind of volatility they saw a couple years ago and prior. And what that means is the primary sector is especially challenged. Take the U.S. market, for example. You have many, many regional local companies that don't have the diversification to handle the increased frequency, to handle those correlations that you're talking about. Reinsurance was their main source of capital relief. Those companies are coming under rating pressure, and it will be challenging for them without the kind of soft reinsurance market that supported them for many years.
One down there, Sean.
Hi, Joshua Gear from Insurance CRM. You mentioned the potential risk of increased protectionism in the US. Is that a trend you're observing in other insurance markets which could negatively impact them?
I think I was talking more about not just within the insurance sector, but protectionism more generally from a sort of national perspective, and the impact that could have just in global trade. I don't think we're seeing particularly a trend of increased protection within the insurance sector. You see it in pockets around the world where governments set up state-backed reinsurers and have sort of mandatory cessions, but in terms of broader protectionism trends within the insurance sector, we're not seeing that.
Yeah, sorry, I meant in terms of increased protection in other regions, aside from the US.
Right.
Is that a trend that you're seeing in other regions, which could then affect insurance? Yeah.
To an extent, but I think clearly, the 100% tariff on Chinese goods being imported is a very stark headline number. Whether that would ever happen, but it's that kind of shift that would have an impact, I think, on global economies.
I think generally speaking, we do see an increase in trade restrictions, right? That's certainly something global players are having to deal with, and they have had to address that issue for a number of years already. So yes, we do see that it is a concern, and it is something that companies, reinsurers specifically that operate globally, will need to adjust their business plans to.
Good morning, Ben Margulies from Insurance Day. I was interested in the comment about interest rates, lower interest and policy rates being associated with softer reinsurance markets. You mentioned, of course, we're moving into a cycle of a looser monetary policy. I was just curious, how far would central banks have to lower interest rates before you start to worry that the reinsurance market would soften? Because right now they're quite modest. The cuts, I mean.
I think that there are probably two elements there. One is, I think that interest rates explain a lot the abundance of capital in previous years and the lack of alternatives. At the moment, because of several years of underperformance, whatever the rates are, it's investors trying to recoup those losses. But what we see is with higher interest rates at the moment, a number of companies have benefited from those reinvestment rates, but they are actually not factoring them into their business plans, meaning that the business that they are writing is generally has to be profitable on its own, without having to rely on those investment returns. At least so far, that is what we are seeing. So that those investment returns come as a bonus and definitely benefit the bottom line results. So I think that we would have to see a level when, again, so that lack of alternatives occurs again. At this point, I think that investors have a number of options which are much lower risk, or at least much lower perceived risk than the reinsurance segment, where they could generate a relatively positive, generous yield. Yeah.
Yeah.
That's right. Everyone will get a chance.
Good morning, Andy Moore, PwC. A lot of the historical data and charts that you showed had points on it where, at similar times in the cycle, there was a lot of new capital and new entrants. That's not been the case this time. Why do you think that might be the case?
We were explaining it, two reasons. One is because at no point we have seen since 2017 that the market was actually, we haven't seen any impairments, we haven't seen any insolvencies, we haven't seen any rating pressures on reinsurers, at least on reinsurers. It's happened on the primary side, yeah? But on reinsurers, there haven't been any pressures on capital. So companies have remained very well capitalized, yeah? So there has been, partly because of those low interest rates, investors were looking for alternatives that ended up in the reinsurance segment here. Companies were retaining those profits, but there was a difference between, having those resources in the balance sheet and actually deploying them. Yeah. So, and that's why we see the market remaining very well capitalized. The ratio of utilization has increased. Yeah, it used to be around 70%. Now it's more like 80, 90. Yeah, so it's become tighter. Yeah. But at no point we have seen pressure on ratings because of the capital position. The pressures have been because of underperformance. We had a number of negative rating actions because companies were not producing results, because they were not producing positive results. But there has been no case, at least with the major global reinsurers that we cover, where the problem was a problem of capital.
And perhaps to add to that, where we have seen investor interest is not in the establishment of new companies, but we have seen meaningful capital injections into existing players, right? And that would be a recognition of a feeling that those specific reinsurers were especially well positioned to take advantage of the improved rates on cat business, for example. The other aspect would be ILS, after being stagnant at around 95 billion for several years, is growing. And again, it's maybe more of a shorter term play, and perhaps that speaks to the investor expectation or a little bit of hesitancy to buy into this being a prolonged hard market where double-digit ROEs are going to continue beyond this year and next. So I think there have been some opportunistic plays on that front. And the other aspect, as we see it from the investor side, capital light business models are getting a lot of attention, right? Whether it's reciprocals, the fronting model, MGAs, that business model that is not particularly capital intensive, and when it's time to IPO or sell, the multiples of EBITDA are very attractive. I think a lot of the capital is heading in that direction.
For the avoidance of doubt, Andy, we're very happy to rate startups. So if you know of any, just give me a call.
Good morning, John Huff with the Association of Bermuda Insurers and Reinsurers, ABIR. So thank you for the presentation. It's always a Sunday morning highlight here at Monte Carlo. I'd like for you to expand a little bit, because I don't think it's properly reported, or it hasn't been as well reported. No capacity shortage, maintaining disciplined allocation. But I'd like for you to expand a little bit on the plenty of appetite to work with seeding companies on complex risk, but not solely on income statement protection. And where are you seeing those risks? I think you referenced AI and cyber, but interested in a little bit more perspective on that.
I think one of the points we've made is that what the reinsurance industry has done is, during the long soft cycle, it increasingly played in the working layers, the active layers, and was helping to smooth the earnings for the primary market. What the industry's done now is step back, go back to a traditional role of saying we're here to protect balance sheets against extreme events rather than smooth earnings year on year. Now, that type of event that would cause a balance sheet event is typically it's an extreme event, it's a more complex kind of risk. It's less sort of proportional cover, if you like, that where capital was being deployed 4 or 5 years ago to a much greater extent. Individual cases will vary, but essentially that's an area where reinsurance can continue to provide value and demonstrate value and produce a good return for the shareholders. So that's a sort of broader trend that we're seeing.
Probably another comment there is when we talk about emerging risks, when we talk about cyber, so development of new products is always reliant on the technology and on the capacity, the support from a big reinsurer. And that's what we have seen. So in, say, either through supporting, say, MGAs or supporting primary companies developing certain lines of products, or reinsurers themselves investing and becoming partners of these initiatives is something that we continue to see.
I think it all fits under the umbrella of diversification as well, right? And reinsurers have looked for opportunities, and we were here a couple of years ago discussing the role of or the future of the reinsurers. So I think what Greg and Carlos were just mentioning fit all nicely under that umbrella of those initiatives.
It's not like they won't go lower. If they go lower into the layers, they want compensation elsewhere.
Yeah.
Okay, go ahead.
Good morning. My name is Rustam Azimov. I am General Director of Uzbek Invest Insurance Company, largest insurance company in Uzbekistan in Central Asia. First of all, I would like to thank you for a very interesting presentation, information which you provide for us. This information will be very valuable to working out our upcoming strategy. Second, I would like to express my gratitude that 3 years from now, we have a rating from AM Best, and I would like to say that it is not only rating, it's some kind of process of cooperation where our staff and our personnel upgrading the qualification and improving our position. We have now positive outlook, which is very much helping us to cooperate with many other international companies. My question is how you assess situation in the post-Soviet area, because I know that we are not only company which is rated by AM Best, and how is your outlook, how is process of integration of this part of the world in international insurance market? What is challenges and what is the risk we are facing, and how you assess this process? Thank you.
Okay, so obviously,
I think potentially this is a seminar in itself to address that question. But
we'll probably go through the whole methodology there. But I think one of the key considerations that we have in that part of the world is country risk, and that's elevated levels of economic, political, and financial system risk there. And that's one of the challenges that those that operate in those markets need to deal with, the volatility and uncertainty in operating in those jurisdictions. We're also seeing that there's a desire for those companies in those regions to try and expand cross-border out of their initial markets into other neighbouring markets as well. But to do that, and on the bigger, say, commercial risks, obviously they need support of the international market, the reinsurers, to help with some of the pricing and expertise and those type of things that go along with those companies. But what we also find is that it is a development, it is a learning curve. Some of the quality of information is probably improving over time, but needs a lot more understanding and sophistication. And we feel, as we've seen with other markets develop, that some of those countries are probably in their infancy right now, and over time we should see some improvements down the road.
Our region needs more focus from your side.
Yeah, and we'll definitely do that.
Okay, I think we have one down here. Yeah. Thank you for your comments, sir, by the way.
Good morning, guys. Thank you very much for that presentation. I'm Yanis Katoulis from Global Reinsurance. In your presentation, you talked about both the increased utilisation of alternative capital and the increased deployment of capital generally into the primary insurance markets. Something that us media heads like to talk about a fair bit is the need for the reinsurance sector to maintain its relevance going forward in the long term. And do you think that those two trends present a risk or a bit of a realignment in terms of how the reinsurance sector is trying to make sure that it does remain relevant for the long term?
I think it echoes, I'm sorry to make reference to this, but there was an event held in London last week with a number of speakers, I think sponsored by one of your competitor publications. And David Howden made a very good point, I think, in terms of the reinsurance industry retaining its relevance. And I think there is a bit of a danger that we've seen that pullback from the working levels, a step back from the risks, and that's very clearly demonstrated in that slide that shows the allocation of capital away from reinsurance to primary business. And I think it is important that if reinsurers step too far back from the risk, then what is the relevance? I don't think it's an existential moment for the industry, but I think it does highlight that primary markets will question: are they getting value for money? Are they getting coverage sufficiently? And I think that's an important element for the reinsurance industry to balance. You've got shareholders that are demanding payback for some pretty poor years, but you need to continue to have customers. I think it is an issue for the market to consider.
I think balance is always key. The insurers need the reinsurers, and the reinsurers need the insurers along with the brokers as well.
Okay, maybe take just two more if we have in the room. I'm conscious we've taken a lot of your time this morning. There's one at the back here.
Patrick Delano is my name. Well, I've heard Craig saying, well, we were talking about de-risking, but at the same time, a reinsurance premium has been growing very substantially over the recent years, and not only because of rate increases, but also because of writing quota share treaties, and especially US casualty quota share treaties. And we have been talking about adverse loss development of this US casualty business. So that's one point where reinsurers have been quite greedy over the recent years, and also writing a lot of MGA business. So I wonder about your comments in this respect. And the second point is relevance of the reinsurance industry facing risk, demand, and needs. Just to remember that 20 years ago there was no alternative risk capital, and because reinsurers were not greedy for cat anymore, or for whatever political reasons, then appeared an alternative market. So maybe there is another issue facing more complex risk or new risk, emerging risk, where reinsurance industry is not offering maybe enough. So that's the 2 points I wanted to raise.
Okay, just a couple of quick comments then on that. Firstly, you will find individual markets where quota share may be becoming a bigger part of it, but generally speaking, if you look at the reinsurance industry as a whole, over the course of the last 2 years, the amount of quota share that's been offered by the reinsurance industry has shrunk. There's been a stepping back from that, let's share the fortunes of the primary market and let's move up the protection tower and focus more on balance sheet protection. Individual lines of business, yeah, we may see some different trends there. So we can dig deeper on that at another point. Your second question, I've completely forgotten. Sorry.
I can probably make a comment there, and I think that the high-level philosophical question is risks in general are becoming more complex, and not everything is insurable. Yeah. So the role of insurance and reinsurance will take some time to quantify, measure those risks, and from the originator of the risk as well to develop prevention measures and risk control measures before some of those risks become insurable. So it's about maintaining that relevance, but not at any cost.
But also in last year, right, we have seen 2 new developments in that space from reinsurers, where Swiss Re and Hannover Re both have issued a cyber cat bond, one on a parametric trigger, another one on a cloud outage. So that's sort of first steps into a new emerging risks. It's not. I mean, Hannover Re hasn't got a high cover on that, but it is a first trial, let's say, to see how these products could work and complement their retro strategy.
And
so I think there's a lot happening in that space, exciting things. Yeah.
Yes, yeah, for sure. And we don't want folks here to walk away with the view that we're not at all concerned with U.S. casualty reserve development, right? It does tend to be one of the more volatile markets in terms of global insurance and reinsurance, and there is certainly an argument that we're going to see some more deterioration this year, and there's no reason for that to abate in the years to come. I think what we are saying is it's being offset largely by very favorable margins and conservative reserving on the specialty side. Specialty and E&S has performed extremely well for a large number of years. And then we know where we are on the property side, where there's strong margins there. So we do expect to see deterioration on the casualty. How much that plays into bottom line earnings is hard to evaluate at this moment.
And the strategies on casualty are quite different. So some are managing it themselves, and like you mentioned, some are taking some of those blocks of business and buying LPTs, ADCs, adverse development covers, loss portfolio transfers on select books of that casualty portfolio as well. So I think the strategies among some of the players are a little bit very different. And where also where the reinsurance market is helping is on the energy sector and the transition to net zero with all the renewable products and those type of things. As you know, all of the going into a new class needs insurance, reinsurance support to make it work, and that's another area which will become of increasing opportunity going forward.
That was quite a long question and quite a lot of long answers, so I think that counted for two. So I think we will call it a day or call it a morning. Just leaves me to thank you again for your attendance and indeed your questions. As I mentioned at the beginning, the materials from this morning will be available on our website hopefully from Monday, and otherwise I hope you have a interesting 2 or 3 days ahead. Thank you.